Stocks took a complete 180-degree turn on Thursday. The Dow Jones Industrial Average and Nasdaq Composite suffered the worst one-day losses since 2020. The tech-heavy Nasdaq plunged by nearly 5% to finish at 12,317.69, its lowest close since November 2020. The Dow shed 106 points, or 3%, and the S&P 500 shed 4% one day prior. The Dow and S&P 500 experienced their biggest one-day gains since 2020. This extreme swing came after the Fed increased its benchmark interest rate by 50 basis points, a move that was widely expected. Investors celebrated when Fed Chairman Jerome Powell said that the central bank was not actively considering increasing rates by more than 50 basis points in future meetings. If you have whiplash from the last 2 days of trading, hold on tight because analysts expect more of the same ahead. We expect continued bouts of volatility associated with both monetary policy and the trajectory of inflation and economic growth, said Liz Ann Sonders, chief investment strategist. Expectations looking ahead are for another deceleration in growth in the second quarter, as well as a likely long-awaited hit to profit margins. To prepare for the ride, she recommends being strategic, diversified and focused on high-quality stocks with good stories and strong balance sheets, among other things. Just like stocks, the Fed also took a 180-degree turn from keeping interest rates at near zero levels since the start of the pandemic to raising rates by the largest amount in more than 2 decades on Wednesday. This comes as inflation is at a 40-year high. Powell has acknowledged that the Fed should have raised rates sooner to prevent inflation from growing, but now the only option is to play the best game with the cards they've been dealt. Rate hike effects: how Fed's bigger, faster rate hikes will affect your credit card, mortgage, savings rates. Dealing with IT, fear the Fed's rate raise. Savers can fight back with these 9.6% inflation-proof U.S. bonds. The stock market was irrationally exuberant yesterday when it rallied sharply just because Chairman Powell temporarily ruled out a 0.75% interest rate increase, said Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. When the Fed raises rates quickly, it is dangerous to the stock market, and today, we are seeing an example of that, he added in a note. Wednesday's rally was absurd considering it is predicated upon a central banker who has been completely wrong for the past 18 months, stating there is a plausible path to a softish landing, wrote Mike Yerk, chief market strategist at JonesTrading, in a commentary.